Hi, everyone, and thank you so much for joining. This is our final market live of the year. But although it's the last full trading week of 2024, there's still so much going on. There's been huge moves in markets. We've seen record highs, both for Bitcoin and also for the Nasdaq. And we are seeing a bit of a new trend. Now, I'm going to show you the first chart. And this shows the Nasdaq, which is the white line, the S&P 500, which is the orange line, and the yellow line is the equal weighted S&P 500, which basically strips out the effect of those mega cap tech stocks like Nvidia, like Apple, like Microsoft. Clear trend that you can see since we've started December, particularly as we've got into the second half of December, this outperformance of the mega cap tech stocks. So the Nasdaq 100 reached a fresh record high. We saw MicroStrategy. Remember, MicroStrategy is the largest private holder of Bitcoin. So it's a bit of a leveraged play on Bitcoin. That was included in the index. That's going to be included in the index on Friday, or you could say on Monday. And that's really having an impact. So Nasdaq and the link with Bitcoin really pushing ahead there because Bitcoin also reached a fresh record high. In contrast, we've seen the S&P 500 equal weighted index really nosedive. Now, what does this all mean? It means that as we get to the end of the year, markets are really falling back to the path of least resistance, which is those mega cap tech stocks which are moving higher. But overall, we are seeing US exceptionalism. Just to have a quick recap of this year, the Nasdaq is up 34%. The S&P 500 up 27%. Now, this compares with Europe, where we've got the CAC is down, so that's the French index, down 7%. The FTSE 100 is higher by 5%, and the best performer in Europe has been the German DAX. Now, that's up 15%, so completely ignoring all of that political crisis in Germany, where the government lost a no confidence vote yesterday. But overall, we are seeing this bit of divergence. And I think as we move into 2025, some key themes that we'll be looking at is, will the rally broaden out? Will people put money to work in the US in the less expensive or the areas of the market that have lower valuations? If they start putting it into energy, into consumer stocks, then that may also flow into Europe. But essentially, we've seen the biggest outperformance of US shares versus European shares since 2012. And if you remember back then, that was at the peak of the sovereign debt crisis. Now, we also haven't finished with central bank meetings and key economic data. So we have the Fed meeting on Wednesday night, so tomorrow night. If we can just look at the second chart. Now, this chart looks like a big mess, but it's not. I would take your mind to the first line on the chart, and that shows that there's a 96% chance of a rate cut from the Federal Reserve next year. Now, that's really what's fueling US outperformance, stronger growth, and the prospect of rate cuts from the Federal Reserve. So they are expected to cut rates by about 3 times for next year. So really kind of positive outlook, but it will be interesting to see what they say tomorrow. Now, this is a big meeting. They're also going to release their economic forecasts, and there's going to be a press conference. So if they say that their growth is very, very strong and they're maybe worried about inflationary pressures, then that could be something that maybe knocks sentiment just a little bit as we start the year, because a lot of the good news is around rate cuts as well. However, that's probably not what's driving inflows into the Nasdaq and into those key tech stocks, because they're so big, they're almost resilient to whatever the Fed does. So that's worth watching. But we think the Fed will stick to quite a steady path and will signal that there will be rate cuts, but they will be gradual next year. Now, this compares to the Bank of England. There's a Bank of England meeting on Thursday. If we just look at the third chart. Now, there's been a big recalibration in UK interest rate expectations just in the last 24 hours. And that's because we've seen a big increase in wage data in the UK. So 5.2% wage growth for the year to October. That was much more than expected and a big upside surprise there. And lo and behold, what have we seen? That has reignited inflation concerns for the UK. So rate cut expectations, it's been scaled back yet again. So there's now, if you can just about see on the chart at the very bottom there, the bar chart, I've circled it. So for November next year, by November next year, there's just under 2.5 cuts expected by the market. Now, at the start of December, that was 3. So the market is looking at the prospect of tighter monetary policy in the UK for longer. Now, that yield differential could boost the UK pound, but it's not that great outlook for stocks. Now, I wanted to also very briefly mention what the commodity space has been doing. Oil down by 2% this year, broadly lower for the energy space apart from nat gas. In the metal space, gold is a key outperformer, up 27% year to date, very much keeping pace with what's going on with US stocks. Now, in agriculture, that's sometimes an overlooked specification for commodities, but there's been some big gains there as well. Massive gains of coffee, up 74%, and cocoa. Do you remember us talking about that earlier this year? Up 180% year to date. So climate change and supply and demand issues there, having a real uplift in price. But also there's been broad losses for grains and corns. What does that mean? Lower food prices down the line because they're so important to all our food chains. In terms of the bond market, not great news for the UK. The UK 10-year gilt was the worst performer in the major global developed market space for 2025. Will that continue? Well, we'll have to see. Could depend a lot on what the Bank of England says on Thursday. But I just want to take this opportunity to wish you all a very happy Christmas and a very happy New Year. And we will be back with more Market Lives in 2025. Thank you.